Hey everybody, this is Paul doing a quick video. Uh, Today is the 14th. The market is currently closed. So this is close enough to the bi-weekly kind of thing, literally 2 weeks to the day after I made my last video. I was waiting for some more information to come through, specifically the CPI report and then specifically the Federal Reserve meeting just to kind of see where we're at. So far, let's talk about this very interesting month that we got going on here. And yeah, it's been a fun month. Okay, so basically, so this was the portfolio, say earlier in the month. Okay, so I was at 53,000. So when I put my numbers right here, that's how much I'm up for the month right now. $2,627.91, so 4.59%. So you might be thinking, oh, well, you just contributed a bunch of money from like DoorDash or whatever. I haven't been doing DoorDash nearly as much because my kids are off school. So roughly $600 has gone towards, the portfolio. So what's up so much? Well, if you kind of compare these two and you just kind of put them together really close to each other, you can kind of get the general idea of what's going up. Is we got different things like the municipal bonds. So we have SPHD, you can see that right there, 41.12. And then we got that right there. These are all, so the biggest movers have been SPHD and AFB. So why is SPHD moving, for example? So my last video, what I did is I made a video and I call it the S&P 493 and S&P 7. So there's 7 stocks that were making up a very large amount of the current market going up. Well, everybody knows that. So everybody, I believe I have a chart of it around here somewhere, but there's 493 stocks that have basically been ignored in this market. Is effectively what's kind of going on. They're up, but they're not up nearly as much as those big 7 stocks that are like $1 trillion valuations and just going like just doing these crazy numbers that everybody wishes they had been in it on January 1st. So it almost looks like immediately on June 1st, everybody decided to go look at everything else that wasn't being bought, and that's why you're getting a rally even higher than where we were before. So you're getting it's called a broadening out rally, and it's actually a healthy sign. It's actually kind of one of the signs you look for in a bull market that, maybe the market's kind of doing some things that are healthy, which may prove to be like this is an actual breakout, not just a fake out. So you want a breakout, not a fake out. Breakouts mean you go up, yeah, you might go back down, but you're not going back down to a new low. So that's what the bears have been waiting on, is like this new low kind of thing. And it hasn't happened since, as you can see obviously here. So what is happening before is like you would get these breakouts right here, for example, and then the Fed would be like, we're doing 75 basis points right now, and then you would get boom, new low. And then the market would be like, okay, well, let's try and break out, and then bulls would get like, oh, hey, look, we just broke above this, we're going back up, guys, and then all of a sudden the Fed's like, hey, inflation data is ridiculously high. It just posted a higher number, and then all of a sudden you get a new low. Well, this time it kind of went down, and then they tried to break out again. It was just very failed, and then eventually just capitulated and just went, we're done. And this is where the Fed was like starting to talk about like slowing down, that kind of stuff. And then you kind of get into this, and then they slow, and now you're just at a straight up pause. So that's where we're at today. They're not calling it a pause, they're calling it a skip. Right now the Fed is praying that they are praying that inflation comes down by the time the July meeting comes around. That they can sit there in the July meeting and say, "See, we might be able to pause this time around too or something." But it would have to fall by a pretty significant amount. So to give you a general idea, this is a pretty useful chart that I saw that's been posted around here. So these are month over month numbers that if inflation goes up by this much, this is what the lines start to do if inflation goes up. So previously we had like these kind of things like zero point 0.6. So the line was effectively going up in a straight line. So what we just got was this, where you kind of see that the line just kind of went down like that. So, and this is month over month. So if we keep getting zero point 0.1, then it'll go like this. If we get 0, it'll go like this. So, I don't think we're going to get some huge crash between, an inflation between now and July. So there might be a 25 basis point on the table come July, but we'll kind of have to see. So that's kind of what I was waiting on was the information from the Fed just to confirm a pause or slash skip kind of thing going on. So also we had CPI data come out. So this is the CPI data that came out, and as you can see, energy subtracted a lot from it, a very large amount of it. Um, no matter what the Saudis try, it's just not working. It's pretty much a case that every time that the Saudis cut, the Russians increase production. I don't understand why they don't see that, you know. But that's who they have to work with. They're best buddies now, I guess. Also, we're looking at the shelter number. It's still unacceptably high. That I don't understand. That is one of the ones that is going to take a. It's going to take something. I'm not sure what it's going to take. In theory, this is what should be happening. So these are like the Zillow apartment list, this type of thing right here. As you can see, literal straight lines down. Um, these were very good at predicting the CPI or the owner's equivalent rent increases, but they've been really good at predicting a fall. And if this proves true, then inflation is effectively solved because this is the largest part of it. So as you can see, at some point, don't know when, when these lines start to catch up with these lines, it might moderate. But at the rate that these things, or however they're doing this survey, something's seriously wrong with this survey. So rates are going to stay higher literally because of the way that we do owner's equivalent rent in this country. So there you go. You know, I don't understand why they do that, but that's just what they do. So, and I believe I have, let's see what we got here. Just got different numbers and whatnot. So we did enter a new bull market, a technical bull market, if you want to call it that. So if you see here, for example, this is when we officially entered the bear market, January 3rd, so literally the beginning of January last year. And this is how long it lasted. This is where it stopped, and you only know this after the fact. So there's nobody that could have told you on January 3rd we're going into a new bear market. If they did, they got lucky. These things are hard to predict, but you can see we fell by 25% between that period of time. So it lasted 282 days. It kind of matches up with some of these other ones, as you can see here. That lasted 229. Some of the longer ones you can obviously see right here. This was the Volcker period, for example. But as you see here, boom to there, 233 days. Now, the one example that you could use as kind of like your guidepost here on what might happen is if you look right here in this little period. So this is that 2001 period. You had like a double dip, bear. So you went bear right here. So this is like 9/11, all that stuff. Came out of it. Everything looked like it was kind of getting back to normal. Went up by 20%. So as you can see here. And then it dumped again. So that lasted 105 days. Now here's the thing. This has lasted 233 days. So this is why people think that the bear case is not making too much sense anymore. Because this only lasted 105 days and then it immediately fell back into a bear market where it fell 32%. So this is when you hear bears talk about like recession in the second half of the year, this is the stuff they're talking about. This is kind of their scenario right here. Is like what they're, I don't know if that's what they're hoping for, but this is kind of where they're at. But this is why it's failing. Because, yeah, it went back into a bull market, which is up 20%, but then there just wasn't enough strength in the economy after 9/11. and then it immediately fell back into a bear market, which lasted 200 days, and then it fell 32%. So that's kind of what we're still got going on here. Now, is there going to be weakness in the second half of the year? Yes, of course there is. Um, just for the simple fact that rates are going to stay higher now. So these rates right here, especially if they raise again at the next meeting, the Fed is predicting that the rates are going to be much higher than what you see right here. They want the rates up around 5.25 to 5.5. So that's where all this is going to need to settle out eventually if they stay there. And they want to stay there for years. So that's going to have an effect. Now, the funny effect is if this prices in the higher rates, this starts to price in a recession, which means 30 year, which is a 30-year mortgage, comes down. So, where are we going from here? Um, I think the story going forward is going to be international stimulus kind of thing. Um, so, like the Fed's like, okay, we're going to hold, we're going to stay tough on inflation, and then everybody's expecting China to cut their rates tonight. So, things like this right here, for example, this international tech one, I think that might actually be doing kind of good because China's going to throw liquidity at it because they just can't have recessions. In the U.S., different credit conditions that we have, like things that measure small business credit conditions, are going down. So the economy is slowing. It's not crashing, which is what should be expected because they didn't raise rates. They didn't keep raising rates. Now we do have little minor upticks in jobless claims, but that could be related to like different summer factors, like auto plants that shut down and stuff like that. So right now, it seems like the U.S. is kind of on rails right now. It's just kind of on a path, not towards recession, and then not towards like a boom type situation, like everything's going to go great. It's kind of like meandering along, just kind of doing his thing. So you could expect the jobs report to keep showing strong numbers. Now, if the Fed keeps raising rates, they keep raising, they keep raising, they keep raising, eventually that something will break. It will break something eventually. But that rate that something breaks seems like it's much higher than what everybody expected. So this market is a global market, and you're going to see it act like such because when China cuts tonight, we're probably going to be up tomorrow because that's more stimulus into the system. Apple, for example, has customers in China. That's going to help their customers in China. So, Starbucks has customers in China. So you have to think about all these international businesses. So, like, while the U.S. Fed is tightening and the ECB, the European Federal Reserve, is probably going to tighten, and the UK for sure, I hope they tighten because their inflation is still at 10 plus per or 13% or some insane number. You know, so you still have major economies in the world that are actually easing and putting liquidity in. So that's what we're kind of watching right now. So it's going to be more like of an international story where international banks pump money into their economy and then it goes into U.S. companies that benefit from it. So that's how we're going to kind of stay at these levels, which is kind of weird. Um, I do expect that you would see if this stays this high and it keeps rallying and it keeps climbing what they call that wall of worry, which is when you come out of that, come out of that recession. So you can see it right here. So this is that wall of worry right here, where you climb out of it. You climb, you do a little drop, but you climb back out of it. So when you climb back out of that, that's when a lot of people who are sitting on the sidelines saying, "I'm getting 5%, but I could be getting 20%." And if you want to take a look, you know, right here, if I go over here, for example, if I go year to date, how stupid do you feel right now that you didn't pile all your money into the Nasdaq, into companies that were down just dramatic amounts? You know, how do you feel about that kind of thing? So That's not. It's kind of one of those weird, like, how do you feel right now? Like, so if you put it into a 5% yielding thing, why do you like? How do you feel right now that you just didn't pile it all into SPY or VU, for example, at the lows? Or especially if you're at 5% yields on your thing, yeah, you feel great, safe, but you missed out on 22% gains right here. If you got a couple $1 million, like, and that's what people are looking at. So there's more money. There's $5 trillion sitting on the sidelines in money market funds that are looking at that, going, "Do I need to be sitting here?" So I think that's kind of where we're at right now. I think that more of the stocks outside of those eight stocks are going to continue to do good. So, like, say for example, my cost basis here is 44. This could go up to 42. I'm hoping that it goes up a little, trades sideways, and then does what we saw before, where the market just kind of trades sideways for a few months, which is perfectly healthy, where the market just kind of establishes a new base, which I hope is right here, before we try to go for new highs. Because that's kind of what the market's been doing. It did it at 38 to 3900, kind of stayed in that area, and then it did it from 4100 to 4200. Now it's kind of doing it from 42 to 43. So it's climbing that wall a little slow, which is perfectly fine. So that's where we're at right now. So, like, let me know what you think in the comments. Y'all have a nice day.